The government is moving to backstop mortgages, get this, above $1 million for the first time ever. Let's talk about it with Mark Zandi. He's chief economist at Moody's Analytics, one of the main guys that we go to for context and color during the financial crisis when housing was really melting down. My first reaction to this was sort of pseudo outrage, and I thought, well, the price of homes is only going to keep going up long term. Do you think this is the right move to make, to backstop $1 million homes?
Well, in some parts of the country, Brian, yeah. I mean, if you live in California, you live in New York, live around D.C., and look at those house prices there and the size of those mortgages, this makes sense. The regulator for Fannie and Freddie, FHFA, they have a formula for calculating the so-called conforming loan limit, and they're sticking to the formula, and the formula is tied to the growth in house prices. And of course, up until very recently, house prices were going skyward. So, this just is following the formula that's been in place for a long period of time. But again, if you live in a high-priced part of the country, $1 million, it's a lot for sure. But, you got to put it into that kind of a context.
Does it help mitigate any risk in the mortgage market, Mark?
This is really on the margin, Brian. Fannie Freddie account for almost half of all the mortgages originated in the country, mostly kind of in the middle part of the market, low middle part of the market. This might expand that out just a little bit around the edges, but I don't think in the grand scheme of things it's going to make a big deal. Certainly not in this environment because, mortgage rates are up so much. If people get a little bit back because they now can get a conforming loan, we're talking basis points, not percentage points. So, in the grand scheme of things, no, I don't think this turns the dial to any significant degree.
This is not 2007. This is not 2008. I get that. We don't have, hopefully, some of these crazy products that we talked about that were tied to mortgages, Mark. Yeah. But you and I have talked about how the real estate market is far bigger and more important than the stock market is to the economy. I know we do a lot of stocks here on CNBC, but real estate matters to pretty much 70% of the country that are homeowners and renters. They're spiking. What's the long-term economic damage from this downturn? Any?
Well, I think in the grand scheme of things, this is just an adjustment, a correction after a period of very rapid house price growth. Just to give you a couple numbers, I mean, between February of 2020 and June, July of this year, which is kind of feels like the peak in house prices, nationwide, across the entire country, prices are up more than 40%, 40%. Just think about that for a second. And then, of course, that means large parts of the country in the Southeast and the Mountain West that were beneficiaries of a lot of folks coming in because of remote work. You saw price gains of 60, 70, 80%. So we're going to see some retracing of that. My sense is, according to the script I have, we might retrace about 10% of that run up. So we go up 40, down 10. We're still up 30% in 3-year period. You can kind of do the arithmetic. And the other thing to consider is, this is a levered investment, right? People have a mortgage. And so when you think about it from, if you're thinking about it as an investment, a return, it's still going to be a pretty good return. So no, I don't think it does a lot of economic damage.
I just worry people won't move, you know what I mean? And there's so much money in just moving itself, just real estate agents, commissions, moving companies, people buy furniture, they paint homes. The amount of money just associated with the action is massive. It's got to be hundreds of billions of dollars a year.
Yeah, I mean, if your point is that the slowing in housing is going to help slow the broader economy, that makes a lot of sense to me. That's going to happen. And, we've seen home sales come way down. To your point, home building is weakening, and of course the house price declines will have some effect. But at the end of the day, this is by design, right? I mean, the Federal Reserve is trying to slow growth, job growth, the wage and price pressures. And it's going to do that by hitting the most rate-sensitive sectors of the economy. There's no more rate-sensitive sector than the single-family housing market. If you want to buy a home, you got to go get a mortgage, and your payment is tied closely to that interest rate. So this is by design, and it's going to do damage, but it's the kind of damage that sort of has to happen. If we're going to get an economy that slows down to a point where we get inflation back in the box.
I'll ask you the same question, Mark, I asked a little bit earlier. I mean, do you worry that the Federal Reserve, can they pull this off? I mean, they're running a balance sheet that's about not quite, but close to twice the size of the annual federal budget of the United States of America. And they're going to try to unwind that. How can they do it?